Welcome, everybody, to this topic, consumer protection in the age of faster payments. My name is Ann Butler. I'm the moderator of the panel here today. I'm from Payments Canada, where I'm responsible for the legal, policy, and research functions. I'm not the real expert in this space up here today, but I have three who are, which is really exciting. So let me introduce the group. So immediately to my right is Elena Gimbert from the Clearinghouse. She is the Senior Vice President and Associate General Counsel there. She's been there for 8 years. Does pretty much all things payments when it comes to advising in the legal space, but says that she spends most of her time these days on the real-time payment system in the US and high-value payments, which is getting pretty hot as well. So Elena will give us an update on what's happening in the US since she was here last year to give us an update on real-time payments there. And she says she will dispel some misconceptions. So I'm looking forward to hearing about that. On the far right, so Anna will be the next speaker, and Anna Badour is well known to many of us. She's a partner at McCarthy Tétrault in Toronto in the financial services department, as well as the co-chair of their fintech group. She's very well regarded in the financial regulatory space, from banking to credit unions to fintechs, obviously, and also is a certified AML and Bitcoin professional. Not those two things together, by the way, but there are two different designations. So although that sounds like a good one, we should work on that one. So Anna's going to give us a really good dive into the current state of consumer protection laws in Canada and how that is likely to play out as we move forward with faster payments. And then in the middle, rounding us all up will be Marilyn Mauritz from Central One. Marilyn has a really big job at Central One. I thought I had a lot of responsibilities, but I clearly don't. Chief Transformation and Governance Officer. That means she has the Transformation Office, the Corporate Strategy Department, Project Management, Government, Member Relations, Corporate Technology, and, oh yes, Legal. Okay, so she's going to pick up and challenge us to think about all of this from a business context as a financial institution, preparing for faster payments and preparing customers for faster payments in the future. So really looking forward to you wrapping that up for us. So the format here today is brief remarks from each of the panelists on their area of expertise to sort of guide us in this discussion. Then we'll have a Q&A session. I have some canned questions in case this audience full of, I can tell, some very knowledgeable lawyers don't put their hand up and ask questions, but I would love to have lots of questions from the audience during the Q&A. We have microphones, it's being recorded, and I have volunteers from my department here to carry around mics so people can ask questions. So with no further ado, over to you, Elena.
Thank you, Anne, and it's a pleasure to be here today. So I'm going to start off by talking a little bit about the regulatory structure for faster payments in the U.S., give a bit of an update on our real-time system and sort of consumer issues that we've seen so far. So to start with the regulatory structure, the first thing I would say is that there's been no government mandate for faster payments in the U.S., nor have there been any new laws or regulations issued to support faster payments, and actually that works just fine. Our current regulatory structure, at least in the payments space, AML and sanctions a little different, but in the payments space, we really do have what we need. And so I think that that's one of the misconceptions about faster payments, or at least in the U.S. There was a lot of hand-wringing around, oh my gosh, you're going to do a real-time system, and are the laws there to support it? And the answer is yes. It's a little bit similar to what I think we saw back when mobile payments first started. There was a lot of hand-wringing, and there were congressional hearings, and everyone was very concerned, but at the end of the day, sort of the U.S. regulatory framework addresses it. I won't go into sort of the safety and soundness part of the U.S. regulatory regime, but obviously I think probably similar to here, it's really based on the supervision and regulation of depository institutions, of banks and credit unions, and kind of all of the things that come along with that. And then as payment system operators, those kind of expectations sort of port over to the operators. And so banks and payment system operators are very much in sync, and sort of the safety and soundness, governance, risk management, all that good stuff kind of goes hand in hand. In contrast, and I think we're probably going to talk about this a little later when we hit on open banking, when you talk about non-banks or fintechs in the payment space in the U.S., they fall under a different regulatory regime, which doesn't really sync up so well between banks and payment system operators. So I'll just kind of leave it there for now. In terms of consumer protection, in the U.S., there's actually a number of federal laws that address it. So there's a law called the Electronic Funds Transfer Act, Afta. It's implemented by Regulation E. And what Afta does is address electronic payments into and out of consumer asset accounts. And asset accounts is a defined term in the law. Historically, it's been really focused on bank accounts that consumers hold. More recently, parts of the regulation have been expanded to prepaid accounts, so non-bank accounts. So for instance, your PayPal account or your Venmo account now falls under certain portions of Regulation E and Afta. And so what that framework provides are some core protections. So it requires upfront disclosures to consumers about the EFT services that are being offered to them. It requires notices to consumers in certain instances if the services are changing. Very importantly, it provides for error resolution. And so a consumer has, within 60 days of their account statement, to go to their bank and say, this doesn't look right. That then triggers an obligation of the bank to investigate and resolve the error within a certain time frame. And included in that error resolution regime are specific limitation of liability provisions for consumers when there has been an unauthorized payment. And I'll talk a little bit more about what unauthorized might mean in a real-time system. So that gives very good coverage, and whether a payment clears and settles in 3 days, same day, or 30 seconds, all of that stuff still applies. And so that's why we've got a strong consumer protection base in the U.S. There's also a federal law that addresses funds availability. It was enacted in the 80s, early 80s, so it's a bit dated, but it serves as a floor rather than a ceiling. So while the law, the quickest funds availability that's required under this law is actually next day, so the day following interbank settlement, there's nothing that prevents faster funds availability. So for instance, in our system, the real-time system, our system rules require that the receiving bank provide immediate funds availability to the receiver of the payment. And then the last sort of consumer protection tool at the federal level in the U.S. is just sort of enforcement authority by federal agencies. There's a Consumer Financial Protection Bureau, which does exactly what the name says. We also have a Federal Trade Commission, which focuses on the non-bank space in particular. And both of those agencies have what's called UDAP authority, so Unfair and Deceptive Acts and Practices authority. So if you have a player in the payment space who may not be particularly violating a specific law, but is doing something misleading or overall harmful to consumers, either of those agencies can step in and go after those parties. So that's kind of the consumer protection overview for the U.S. In terms of what we're seeing in our real-time system, it's still a pretty young system, so it's less than 18 months old, so kind of a toddler, baby system. And the activity in the system to date has been primarily B2B, business payments, and that's because as banks join the system, they tend to lead with their commercial bank rather than their retail bank, and hence that's why we've seen primarily business payments, although recently, very recently, within the past 2 months, I would say, we are starting to see consumer use cases which are account to account. So consumers moving money between their checking and their savings account. And that's obviously a very safe use case for consumers because they're paying themselves. I suspect that when they start to pay other people is when we will start to kind of see the phone lines light up a little bit. But so far, we haven't had issues. I guess the one issue that we've been looking at more as a system operator and from a rules perspective is that there's a requirement in our system rules that for consumer initiated payments, the sending bank has to provide the consumer with the name of the receiver who is associated with the routing information that the consumer has provided. And the thinking there is that these are immediate, these are irrevocable payments, and so we're trying to mitigate the risk that a consumer is going to send money where they don't really mean to send it, either by mistake or because someone is tricking them. So when we wrote the rule about 3 years ago, we had thought that by at this point in time there would be one or more directory services where a bank could kind of take the routing information that their customer has given them, kind of look it up and come back to the consumer and say, okay, based on the information you've given me, you want to pay Anne? And I would say yes. So it turns out that those directory services have not really materialized in the way that we thought 3 years ago, and we could probably have a whole nother session on that. And so for these account-to-account payments, there has been some concern by the banks, gosh, how are we going to kind of meet the idea that we want to sort of protect consumers from sending to the wrong place. And so what the banks are doing right now is sort of a concept of validated accounts. So they're looking at their customers' previous payment activity and identifying accounts that they know those consumers have sent and received payments from previously, and essentially creating a whitelist for each of their consumers to say, here are the accounts that you're allowed to send to, and you're not allowed to send elsewhere. So for an account-to-account kind of use case, that's fine, because there's only so many accounts that you're probably going to be moving money in between. If they want to add a new account, there are ways that you can do that, either through sort of external third-party services or by doing kind of penny transactions through the ACH. So there's kind of ways of doing it, but it might take a day or two. So that's where we are in the real-time system.
So I led in with a comment that you thought you would dispel a few misconceptions about what's going on in the U.S. So what would those misconceptions be, and what's happening?
Well, I would say the main misconception was what I kind of pointed out at the beginning, that there's not laws in place to kind of address faster payments. There's been a lot of wheel spinning on this issue. There have been work groups set up, and they're kind of snipe hunting, in my view. They're kind of going out and trying to look for holes that really aren't there. I mean, I will say that, probably what people are not focused on, and I think we'll probably talk about it a little bit today, is the shift from sort of consumer retail payments, which at least in the U.S. have historically been debit-based, right? Your debit card, your credit card, check, ACH pulls from your account, to, push payments, irrevocable, immediate. That, I think, is a bigger shift, I think, in the way that consumers and banks and everyone need to think about sort of fraud and protections for consumers. That's the piece that I think a lot of the discussion in the U.S. is missing, that part, and then instead trying to find like holes in the consumer protection regime.
Well, thanks, Elena. I think there's a really great grounding in what's happening in the U.S., and I think you're going to hear with Anna what's quite a bit different in Canada, and there's a few points that you've called out that I think as you listen to Anna, you're going to hear some fundamental differences in the way Canada's handling the consumer protection. So over to you, Anna.
Great. Thank you. So Canada is different. We're very much still in a fragmented state in terms of consumer protection in the payment space, and very much in flux. So you have a mix of provincial and federal regulation on the consumer protection front, and there isn't much in terms of payments specifically, other than in respect of prepaid cards, dealt with both federally and provincially, and credit cards to the extent that they fall under credit agreements. And so as a result, we don't have something like you see in the U.S. with Regulation E, which is a overarching framework on payments consumer protection. That said, we are in flux. There is a consultation process that will lead to legislation on regulation of a national retail payments framework, which will lead to probably some more focused consumer protection provisions addressing payments specifically. But as it stands currently, for example, if there is an unauthorized transaction involving either a debit card, a credit card, or a prepaid card, those are dealt with differently. They're in different portions of either legislation or in some cases codes of conduct. And so it can be quite challenging for a consumer to understand how payments are regulated. On top of that, I would say there is still some overarching regulation to the extent that, for example, what we refer to as unfair business practices, those are regulated under consumer protection. So to the extent that what we in the U.S. you would refer to it as UDAP, that kind of behavior, that does fall under consumer protection legislation, but is nowhere near as strict as the U.S., nor is the Canadian equivalence to the CFPB as active, and they also have a much narrower scope. So the FCAC, the Financial Consumer Agency of Canada, essentially only regulates federally regulated financial institutions and some networks, et cetera, that have signed on to codes of conduct. So there isn't, the way that you have in the US, a CFPB that has a scope of regulation and enforcement over all of the financial industry as a whole. Instead, you have a mixture of provincial regulators, a federal regulator that has a limited mandate to certain types of institutions. So all this kind of leads to, depending on the type of payment product that you're using and the type of institution that you're engaging in the payment with, you may have, as a consumer, different rights and remedies, and it's fairly complex to understand. So that's where we are in Canada. There is, both the fact that we've got a new retail payments framework coming, as well as the Bank Act itself is being amended to bring in a more comprehensive consumer protection code, which in some ways as well aligns better with some of the provincial legislation. So definitely still in flux in Canada, but not dealt with as comprehensively and as set out in stone as you would see in the U.S., where REGI has been in place for a number of years, and there is an established way of dealing with payments. So definitely seeing kind of more change coming in Canada as we, in parallel, move to faster payments.
Thanks, Anna. So Marilyn, sitting in the business and thinking about this, particularly not just wearing your lawyer hat, but your strategy hat, talk to us about the challenges and opportunities for financial institutions navigating this complex environment.
Yeah, so we're in an interesting period of time. Payments is evolving quickly. Payments Canada is modernizing their payment processes and policies and infrastructure. The bank or the federal government is looking at open banking. And like all financial institutions, the credit union system is looking at their payment options and what is the strategy going forward. Because even all of the payment systems that we're talking about, that modernization, that just is the foundation. It is not necessarily the innovation that can be built on top of that foundation. So we're looking at that aspect. And I do hear about all the different consumer protection laws. And they're important, but I do think it's still incumbent upon the financial institutions to do a little bit more, even if the law isn't quite there. And I couldn't help but think about the case that was in the paper this week, where an account holder transferred money to a friend, and her account got hacked. So that money never got to her friend. And she went to her bank and said, well, help me out here. Like, aren't you going to keep me whole? And the bank said no. Right? With credit cards, you know that the bank is going to keep you whole. There's assurances that, that if something like that happens, you're going to be kept whole. But with all these new payment options that are coming, the consumers is going to be looking to their financial institution and saying, keep me whole too. And that isn't going to be the case with the new faster payments, because it's going to be irrevocable and the risk will be borne by the consumer unless the financial institution does a few other things to mitigate those issues. So I look at it from the business side, and again, beyond all the laws, what is the reputational impact that a financial institution could possibly have, because it's not educating its customers, it's not putting investing in cybersecurity, info security, so that there's two-factor authentication. There's not just knowing who your customer is, like thinking about who they're sending the money to, some authentication processes that are there in place to help protect the consumer. Otherwise, the financial institution will bear reputational loss and financial loss as well. In this case, the account holder said, look, I'm done with this financial institution, this bank. I have to go to an ombudsman. I don't know how that works. It's so complex. It's not easy. How am I going to get my money back? I'm just going to close my account here and I'm going to go elsewhere. So I think all of those things are still coming our way with faster payment. As much as it sounds really great, and it is great, there are going to be some implications from the business perspective.
So Anna, you want to weigh in on a couple of those
Sure.
comments?
I just wanted to add, maybe in terms of a plug from a consumer protection perspective for faster payments. There's a lot of issues right now with consumers where they're subject to holds, et cetera, and there are entire fintech business models that are really based on shortening those time periods, particularly for financially stressed portions of the population. And I think faster payments on the whole is really pro-consumer in terms of giving access to that immediate payment, which in many segments of the population can make a big difference. The payday loan model in many ways is based on, the fact that we don't have faster payments. And so adding this type of functionality to the payment system on the whole is very much beneficial to consumers.
Yeah, I'd like to pick up on maybe comments that came from all three of you in the discussion and sort of summarized by Marilyn at the end. And this is around consumer expectation. So in a world where there are so many types of payments by which a consumer can purchase or pay for something, and as you said, the credit card, why would I use anything else? I could use my credit card. I have different expectations based on whether it's my credit card, my debit card, a faster payment, or other payment mechanisms? Or do I have those expectations? Do I even understand? How do we tackle that problem as an industry so that consumers actually have a better understanding of their rights and obligations when they're engaging in payments? Or can we?
The typical answer would be disclosure. And I do think there's probably a lot more education in the consumer sphere now in terms of what interchange fees are and what they mean and how that ties into liability for loss, and more of an education that, if a transaction goes wrong, it's better to have paid with it through a credit card than through some other payment method. But there's still quite a bit of learning to be done to really catch up to those discrepancies, and maybe in some cases it's harmonizing more across payment models in terms of dealing at least with unauthorized transactions, of having a dispute system that may be more streamlined and more consistent across different models, a single point of contact or something like that, or at least having that disclosure up front in some way, and that may be a policymaker's role in terms of educating, et cetera.
Any other thoughts on that?
Yeah, I wonder sometimes when I look at the stats, between 2008 and 2014, credit card payments have gone up 9%, almost hitting 30%, the same with debit cards. Cash has gone, we're not using cash. I carry, $2 on me sometimes, most of the time, frankly. And when I hear about, who's going to bear the risk, if something happens, when I do a payment, I wonder if I'm not going to use my credit card more often. Because that may feel a little bit more secure to me than doing a faster payment. Do you see that happening? Is that happening in the U.S. as well?
So I would say that probably the U.S. was not as good as it should have been, and not just talking about our system, but some other sort of consumer P2P type services in the U.S. probably didn't do as good a job on the front end as we collectively should have in the U.S. about informing consumers. These sort of irrevocable P2P payments are great when you're paying your friend for beer last night or sending money to your brother. But yeah, if you're buying something on eBay or Craigslist, you probably want to use your credit card. So helping consumers, understand the different use cases and when a real-time payment is great and when you want to use another payment method because it's got protections, I think is really important. We have started to do that more. I think not the Clearinghouse, for instance, published sort of a consumer brochure that's on our website and that our participants can use. We've shared it with the Consumer Financial Protection Bureau, and I think that the Bureau will probably put something out as well. So this idea of kind of getting it into consciousness that there are different types of payments and you use them in different ways is important. I think another issue that has caught consumers by surprise is the idea of, well, what is an unauthorized payment? It doesn't just mean that you're unhappy with what happened. So specifically with credit push payments, right? So I think, again, I mentioned earlier that especially in the consumer market, you're so accustomed to paying with debit cards, credit cards, or sort of doing those monthly ACH pulls from your account. Those are debits, and typically an unauthorized debit means that someone has gotten into your account and pulled money out. It's an unauthorized payment. But if you are a consumer and you're pushing a payment out and you've been tricked into sending the payment to someone who's claiming to be the utility company but really isn't, that's actually not unauthorized. It's authorized. You intended to send that payment. You followed you logged into your account and followed all of the authentication. It's just that you've sent it somewhere where you shouldn't go. So that piece, I think, can be a little bit of a gotcha, again, if the consumer sort of education isn't clear, that if you go into your account and you authorize a payment, it is authorized, and under the U.S. regime, your bank doesn't have to cover that. It is, in fact, an unauthorized payment. Now, what are banks actually doing in those situations? I suspect in some cases they are still making their consumers whole to kind of keep them happy, and to the concept that sometimes you don't just stick to the bare sort of legal requirements, you do a little more. But there's definitely a consumer education piece of this that has to be happening. As we're building products and thinking about how to innovate in these systems, you really have to start the groundwork with your consumers so that they understand what's coming, and when it's available to them, they can be smart about it.
Just going to add from the credit union system at Central One, we provide the payment solutions to our credit unions across Canada. And one of the things that we're looking at right now is mandating, a stronger passwords, because the hackers out there, they're going after the financial institutions, the credit unions, and they're just going for the weak channels. They're going for the weak passwords. And so if we can do more, to mandate that they have to, ensure that all account holders have stronger passwords, that goes a long way to helping the consumer as well. So really, as feeling a little bit of a duty to our credit union members and as well as their customers, that making sure that there's in place better protection for cybersecurity and info security. It is an investment. It is a cost, but I think that it will give returns in the long run.
And I would note in the U.S. that sort of, again, the regulatory framework, the expectations for banks and credit unions, there already are pretty prescriptive information security requirements for sort of online banking and so forth. And in the real-time system rules, we actually have information security requirements. They're pretty much just a restatement of what's in the sort of federal regulatory framework, but we thought it was important because information security is so important in an immediate, irrevocable system that we kind of put it into our rules and actually require the banks when they're signing up to the system to agree that yes, we can meet these standards.
I would just add that it will become more acute with real-time payments, with higher velocity of payments and the irrevocable aspect that you talked about. That any sort of weakness in those information security standards and vulnerability to fraud will become heightened in that context.
Yeah, it seems from listening to the three of you, there's so many layers of protection that you need to think about in modern faster payments, from the consumer's understanding to what's the security and that you have at the front end, and the detection you have for bad actors at the front end, but also the tail, as you spoke about. What kind of payments are going where, and it's on the financial institution at the front end to be doing its due diligence, but also at the recipient to not be enabling fraud on the system at the same time. So big challenges for us to think through, but an opportunity to think about how we set up that framework most successfully. I guess I'm curious, as I heard you speaking about the role of regulators in this space, keeping in mind, Anna, as you said, that in the future there will be a retail payments oversight framework. We have this other regulator, the FCAC. Is there something more or something else FCAC should be doing in this space, you think, or not? That's a loaded question for fun. I asked that question to entertain myself.
Well, I would add, interestingly, that the Bank of Canada will be the regulator for the new National Retail Payments Framework, so it's not just on the FCAC. And again, as I mentioned, they have a fairly limited scope of who they regulate in this space. They've issued a number of notices that have to do typically with unauthorized transactions, and in particular, the use of aggregators and open banking-like activity and the risks there. So certainly there's a lot of education going on. And the FCAC is in the process of changing as the new code comes in through the Bank Act. It's very much growing in terms of both size and scope of powers. So I would expect them to be more active in the future in this area. I think, traditionally it's been a fairly narrow mandate that will expand.
I'm going to keep going with my questions, but I also want to make sure I open it up to the audience. So if anyone has a question that they want to ask, there's a microphone right over here. If we could have, Jillian's going to grab it for you, but you beat her to it. There we go.
So just on the nature of an appropriately authorized payment, it occurs to me that it could be appropriately authorized, but by someone other than the actual account holder. So if it's a victim of an account takeover, if someone who's either got hacked or phished credentials and goes through the right channels to authorize that payment, what happens in that instance, and who has the liability?
So in the U.S., account takeover would be considered an unauthorized payment because, yes, someone is in using the correct credentials, but it's not you. So a consumer and a business would be protected in that instance.
The one thing I would add there is, was that as a result of you sharing your credentials or not? And that tends to be the key distinguishing factor.
But can you ever really find that out? Yeah.
Only if somebody you know confesses it to you, right, Anna? I share a little secret.
You may be sharing it with an aggregator who have it, available somewhere that is fairly easily accessible.
Sure, the screen scraping business is predicated upon that. So I suppose that could be a very bad actor, yeah, if
Or
they
it could
took
be
advantage of that.
a database hack that just hasn't come to light yet. And I guess a follow-up question is, what do you think is the future for two-factor authentication?
I can take that one. I think it's going to grow. I think that when I just look at, in the last year, what I saw in the banking credit union space and the number of brute attacks, phishing attacks, we're going to have to do more. They're ahead of us all the time. And we have to find more security features, and I think that is one of the better ones. CAPTCHA, two-factor authentication, these are the ones you're seeing. I'm sure you already have them in with your bank, and I think we're going to see more of that.
And to the extent that we're speaking about authentication, it really ties into digital identity, and as we start to move to more sophisticated models there, that will really tie into how you authenticate with your financial institution.
Biometrics is a big one. We're seeing that. I feel like I do a lot of biometrics, the thumbprint all the time, and that seems to be also another way to protect yourself from the attacks.
Yeah, I think that's very important points. I want to talk now about real-time payments and ISO 20022 data traveling with those payments with you, and you have more information. We were just talking about account takers. You have more information, more potential for bad actors to do bad things. And I guess I'd love to hear. Okay, I will park my question if I can remember it. It's written down, and I will have the question from the floor. Sorry.
It was sort of following up on what was just discussed. The incident you talked about with the money being transferred between the bank accounts, that was an interesting one because it was hacked through the email, not through the authentication you used with your bank. So I'm curious, as we add more and more kind of overlay services through fintechs into the system, do you perceive the need legally for kind of a new liability model in which, is it Google that's responsible for the protection of my email account, or does my bank now have to work somehow with Gmail? It's just becoming increasingly complex.
I would just say that's the million-dollar question behind open banking. How do you make our current liability model work in the context of an increasingly complex kind of spider web of different players, and different jurisdictions have taken different approaches, and some have been quite clear in how they allocate liability. I think if it's vague, you're going to run into trouble. But I think crafting that framework with the number of different players and the fact that you have a mix of extremely well-capitalized financial institutions, small players that can't bear the loss, and want to innovate at the same time, that's a very complex framework to set up.
In that case, the question, how when you send your Interact payment, that, you ask a question and the person has to answer it. Well, didn't she say something? It was like one of the Beatles.
You had 4 choices.
Like you
It
have
was
4
one of the big-
choices. And so those are the things that I think, the financial institutions have to educate the consumers on, and maybe have to mandate something that is a little bit more, more difficult to crack. That is just so easy, right? And I think of even some of the ones that I have, but I know even from the basic, it used to be that you only had to put 4 digits in for a password. Now you see it's being expanded to 6. The stronger the passwords are the ones where you're using some other character. But there are still a lot of people who are using 1, 2, 3, 4 as their password. Mm-hmm. And that's where the consumer education needs to take place, because that's not... They have to know that that is a weak password, and even though I know we can't remember all our passwords, you got to come up with something a little bit stronger.
Yeah, but I think your question was great, because it's bigger than that, right? It's around when you're changing the financial system from what has been a smaller number of players who are well known to each other, right? And have developed rules like Payments Canada. Our rules are essentially the agreement between the participants on how they're going to do business, and it includes who's going to be responsible for what if something goes wrong. When you expand the participation into broader groups, you have to think about regulating that differently, because it's no longer a group of close cousins coming together and deciding how to play. It's going to be a very different regulatory regime. And when a Google or other big tech player comes to the table to participate in the payment experience, not to provide email to somebody who happened to use it for their secret message, that's maybe a different experience, but when they're participating in the payment system, they're going to have to be part of that regulatory regime. In my view, they're going to have capital to back up the commitments to customers. That's a very different regulatory regime than we have today, but a very important one that the Department of Finance is working on under the Retail Payments Oversight Framework. I think we have to recognize that will change for fintech participants that could become regulated. There will be different criteria around, what lets you play ball within the payment system. It's a privilege and a great opportunity, and it also requires risk controls and protections for consumers that will have to become aligned with the broader financial sector regulatory environment, in my view.
Not being a lawyer, but just trying to follow along with the line of questioning, what kind of expectations are there on the financial institutions in terms of the level of protection? We're at a conference. There are lots of solution providers downstairs. There are people that have solutions that would directly address the kinds of issues that we're talking. And we have a regulatory regime where financial institutions, federal ones, are certainly visited regularly by the regulators, and there are expectations of the level of protection around AML. Are we going to see an environment where we're going to have expectations that the major institutions certainly will have top-level fraud protection, top-level security protection in place? Or are we going to go to a softening of expectations?
So in Canada, there isn't that much in terms of prescribed requirements. There's general requirements on operational risk, et cetera. There's some cybersecurity guidance that's fairly limited for financial institutions. And things like fraud, really, at the end of the day, they're financial incentives, right? It's not dealt with from a regulatory perspective because every financial institution wants to minimize fraud because at the end of the day, that's a cost for them. So it's really an economic incentive more than a regulatory requirement. And as a result, there is a constant desire to try to minimize fraud because at the end of the day, that's going to hit the bottom line. And that's what drives the acceptance of new tools and trying out of new technologies, et cetera. One thing we haven't talked about is the sharing of data between financial institutions. Our privacy regime, unlike in the US where you can have information sharing between different financial institutions, and feel free to correct me if I'm mischaracterizing, particularly in the context of AML, et cetera, there isn't as much ability for financial institutions in Canada to share information on certainly things like fraud, which is not legally based as much as trying to minimize that dollar amount, or even AML. And so I think there could be a role to enable that greater information sharing in order to increase the intelligence available to each institution and share the knowledge across. So if there's a pattern of fraud that one institution is seeing, the others can be apprised of it immediately without the risk that you're sharing personal information in the process.
Thanks. Next question.
Well, I'm going to answer that from the business side because I have enterprise IT under me, and one of the first things I wanted to do was strengthen our cybersecurity. Doing an assessment, finding out where the gaps are, because as a lawyer as well, I always think that I don't want to be on the front page of the newspaper. I want to make sure that what we have is going to be, secure to the extent possible. Because it is a reputational issue, it's a financial issue, and I would hope that other institutions are thinking the same way, so that it doesn't necessarily have to come from the regulators or, through regulation, that we're taking cybersecurity seriously. I know that there are lots of different software products out there, and if you go down to the trade floor, they're all there. A lot of the companies are already now building into their products cybersecurity. So I think that the whole attention to cybersecurity, information security has been heightened, and it's being built into the software already.
But I think back to some of the points, Anne, you were raising about sort of bringing new players into a space that has been pretty homogenous from a regulatory standpoint. You absolutely start to see the cracks between the regulatory structures, and that's certainly true in the U.S. We have very defined, it's sort of by what segment of the economy you're in was going to, we have healthcare privacy requirements, but that's only for healthcare providers. We have financial sort of protection requirements, but only in the financial space, and then you have these kind of entities that are in between and that frankly don't fall under any. And as a consumer, you don't know that. You're using a service, you don't care, you don't know, whether this service provider falls under this regime or no regime or whatever regime. So, I would not want GDPR in the U.S., but certainly I think the notion of thinking more holistically about having sort of common standards across industries, we need to do that in some way or another.
Yeah, and if I just add one more thing on the GDPR, right, recognizing it's another regulatory differentiator from, the Canadian environment and the European environment. The power of our privacy regulator is not the same as the regulators that have quite big hammers, not just sticks in the EU for violations. And you see, though, that our privacy regulator is willing to do what they can do with the tools that they do, having recently taken Facebook to court over the things that they're not able to administer penalties on. But that's some of the differentiators for us as a country relative to some of the other regulatory environments we can compare ourselves to. But I think the banking sector and the financial sector in Canada has such a great reputation for protecting the information of its customers. Certainly, I know, we don't see that customer information. As we move forward with our systems, we are trying to keep as little risk in the center as possible so that we are not a good target for that kind of thing. And I think that's a very important principle to guide us and be our anchor as we move forward. And I don't know who stood up first, so over to Mike. Yeah. At the mic.
Thanks, Ann. Thinking a lot about this subject and the event that we are alluding to today, the example that was in the paper. The receiving FI of that fraud, I mean, they know exactly what account it went into. They know the individual who holds that account, and still they weren't able to make the original payee whole. So it just seems like there's something amiss there. It wasn't like the money went into a void and we couldn't track it down if we wanted to. So definitely a regulatory loophole there. In some of the other countries that we've looked at, the UK, Japan, Sweden, I call them, they're sort of on the cutting edge of putting in consumer protection for certain types of authorized fraud, which I think this example would fall into. So I was just curious what the panel might have to say about consumer protection for the authorized transactions, and if there's any future there for regulations in that space.
So I know in the U.S. certainly the consumer groups are pushing for that concept, and I at the end of the day it's a public policy call, because if you're going to make banks responsible for authorized fraud, I mean that changes, right, the cost structure for banks. They're going to, and I shouldn't say that banks don't have predictive fraud systems now. They do, and in fact, we require in the real-time system that before a payment goes into our system, the sending bank has put that payment through some form of fraud review. So it's not like we're just flying blind, but I think to up it and to say, yeah, in fact, banks, you're going to be responsible for authorized fraud is really sort of a shift of cost from, the consumers to the banks. And so the question then becomes, how is that cost absorbed? And I'm guessing it's, higher fees, if not for the real-time service, for some other area where maybe consumers don't have as much choice and they're stuck with the bank. And I think potentially, right, banks then become a little bit more picky about who they want their customers to be. So I think you have to weigh the sort of pros and cons of that kind of a public policy shift, but at the end of the day, it's a public policy call, not mine.
The other impact would potentially be, from a privacy perspective, the more information you have, the less fraud you're going to deal with. And so you have that tension. We certainly see it with AML and privacy all the time, and you see it with fraud and privacy, because in order to minimize the amount of fraud, you collect more information, which then pushes back against your privacy requirements. And so you end up with that kind of trade-off, and you add friction as well, because really at the end of the day, if you're liable for more, we refer to here as authorized transactions, you have to do more due diligence. And the way you do that is you collect more information and you slow down the process at the get-go. So there are trade-offs to that as well.
Yeah, it's the trade-offs between protection of the consumer, reasonable protection of the consumer for transactions that involve the financial institution, and when does the line shift from reasonable expectation and protection to asking financial institutions to ensure the activities of consumers in the marketplace altogether. So there's this there's a tendency sometimes to see the line, you think it should be all the way over here, so there's an important discussion around where's the reasonable line in there. But I think it's my view would be it would be unreasonable to expect financial institutions to ensure all of our purchasing decisions in case we get any one of them wrong. So I think there's that balance from a public policy perspective to think about. Question over here.
Sure. So following up on the comments about the kind of looming public policy question, and as well some of the comments earlier on kind of consumer education. So I work for an organization that tries to help with financial literacy across the country, and something that we're finding increasingly is actually having to work on the digital literacy end of it as well, especially with more and more platforms coming out. The problem with that is especially in the course of our work, it tends to really be scaled with income. So higher income people, more educated, more digitally and financially literate. As a result, we're kind of seeing this looming problem where people on the lower end of the income spectrum have less resources but are also more at risk because of the fact that they don't have the same literacy or education level. Something that I'm wondering though is in order to remedy that and to stop kind of like a really bad divergence on that, do you think that that's something that has to come from like a regulatory angle, like that's something that needs to be an incentive that's pushed by FCAC, or do you think it's more of a business solution that this is something that can be tapped into, either in terms of acquiring new clients or some other angle?
I would just say that I do see financial literacy as something that that you can sell or market. If you're offering a service, and many fintechs kind of try to target that segment, they're offering a service that consumers may understand better. There's there's better user interface. There's more gamification. It's funner to learn the digital aspects of it, and you can differentiate yourself by providing that education. Because in many ways, a consumer that understands better what they're doing from a financial perspective is probably a better consumer, one that will, try more products, that will use your institution more. So it is something that I don't think has been fully taken advantage of as a selling feature by financial institutions.
Financial institutions are heavily regulated as it is. I think to regulate something like that would not be ideal. Most financial institutions are actually doing a lot in the financial literacy area, and to take on also, putting some extra protections in, asking for, two-factor authentication or, better passwords. Those are ways already that they can help on the digital side to have them understand why there's increased, security, but it is for their own good. Again, consumer education. There's also it is a way for financial institutions to also help market their products is through financial literacy and maybe digital literacy as well. But I would hate to see something like that regulated because there is already so much regulation in the financial institution space.
Thanks. I also like to suggest, if you're still around on Thursday, that there's a session at 11 a.m. where the Bank of Canada and Payments Canada are talking about their research. There's some really interesting research out of the Bank of Canada on financial literacy, income, and use of digital and cash. So it'd be a great session for you to sit in if you're interested in that. So I'm plugging for my team, who will also be speaking there. So over here, yeah.
I just had a question with regards to enforcement. So as much as we manage things through regulations and we monitor with cybersecurity and information security, at the end of the day, when a fraud occurs, it falls under Section 380 of the Criminal Code. Now, are we in Canada, because it sounds like the U.S. already is, but are we in Canada working directly with law enforcement agencies to start streamlining those processes and those investigations to help each other out?
I don't know, because I'm not working for an FI anymore. So.
No, well, I'm just going to go back to my newspaper article as my source of the truth. She went to the police. The police said, sorry, it's small amount. We don't really have the time. Can't really do anything about it. She was left actually in a very bad position, not really getting the help that she thought she would get in what was clearly a fraud case. And so I think that the enforcement probably isn't where it would be. Like, police aren't going to take that one on and really spend a whole lot of time pursuing that bad actor. Maybe if the money, dollar amount was millions of dollars, they would go after it, but not for these small amounts.
Yeah, and I know just from some previous history that the file numbers can reach in the thousands when it comes to fraud. So I guess that's where my question is sort of generating from is that something that people are looking at? Can we partnership with law enforcement to better protect the consumer and better manage what's happening out there? Because it's true, if you get a file that's for $5,000, $10,000, $3,000, even $10,000, the police won't look at it because they don't have time, because it's the involvement of writing warrants, et cetera, to get that information to action it, which takes years. So is there going to be an opportunity for that partnership to develop and potentially streamline that?
So I do see the potential longer term, but I think right now this would certainly fall behind in terms of priority money laundering.
Yeah.
And that, for a long time, The police resources have been under-resourced in that area, and obviously there's a lot of media articles right now and a lot more focus on it. And maybe that will start to create that kind of white-collar crime expertise within the police force and more focus on these types of issues. But, you know, if they're weighing a money laundering investigation and a fraud investigation, money laundering is going to take precedence. I think on fraud and particularly in the cybersecurity context, you may see more effect from the class action bar. In particular, last year there was it came in place the requirement to give notification of a data breach, and the real trigger that happens then is the class action lawyers see that and they get very excited. And so, you know, sometimes you get policy indirectly through class action lawyers.
Yeah.
I'm not one.
Yeah. We had, one of our members had a phishing attack, and it was quite severe. We did, you know, talk to the police force about it, and they wouldn't take it on. They actually wanted us to do more, to almost lobby so that, you know, the police force would take it on, but it's just not one of their priorities right now.
Yeah, and that's a standard, right? Law enforcement will rely on the FIs to develop the information, and then if it gets big enough, they'll process it. So
Yeah, I'll head over here to
Thanks.
Trish, and then,
So we have a topic for next year. Wow, you have to be like 6'4" to use this one.
yeah, you take it off.
Thanks. So we have a topic for next year, which I think is how do we partner with law enforcement for
enforcement.
consumer protection. Great, we're starting already. I wanted to go back to where you were trying to get to, Anne, which is the data with respect to ISO and
Faster
consumer
moving
protection.
payments, which we
Yeah.
sort of covered when we talked a bit about privacy. But yeah, I think
Yeah,
that's
I
another
think there's
area
another
of concern.
topic
So
there.
I'm interested in any comments you have on managing that risk. More data, it's moving faster, more bad things can happen.
Right, so I agreed, there are risks with accompanying data, accompanying payments with data, including the fact that there could be personal information on there. There could be, you know, information that is nefarious in some way, such as a link that leads somewhere that, you know, triggers some sort of issues. So there is some need for controls probably in terms of that data, although again that adds friction, and in terms of understanding, you know, who puts in place those controls. It's a trade-off really at the end of the day, right? Because someone may want to put highly personal information on there, and so I think we have to give some thought to, you know, how that data will be managed. We've seen in the U.S. where Venmo essentially is a messaging app, and so there's data going through with payments, and people put in, you know, information such as this is to repay for the drugs, kind of thing like that. And so, you know, there might be messages that, you know, seem outrageous, but people will do them. And again, ties again to money laundering, et cetera, because that helps to kind of filter some of that. But there's a trade-off there, and there's a need to think about controls and the filtering of that information and how that's going to happen. I don't think there has been much, at least that I've seen, much consideration of what those controls should look like at this point in time.
So for our real-time system, we're using a very skinny version of ISO, not the full-blown ISO that we're going to use eventually for wire. And we were already in payment systems in the U.S. I mean, we didn't have the concept of like a free-form message field where, yeah, it's shocking when banks tell me the things that are put in those messages, but that hasn't really been an issue for us in the real-time system because, I mean, we've already, as a payments company, been handling very sensitive consumer data, and that's just the golden egg, and you know that is protected above everything else in your organization, and it's very, very hands-off, so hasn't been a big change for us.
I want to maybe pick up, Dawn's got a question, and I know we're running short on time, so I'll throw it over to you, Dawn.
Thank you. I just have a couple of things. First of all, a point. Have you considered partnering with the Canadian Anti-Fraud Centre? Because they are the real group that does intelligence in these areas of fraud, not individual police forces. So if you're talking about complaining to individual police forces, forget about it given the resourcing. But the Canadian Anti-Fraud Centre is financed by the RCMP, by Competition Bureau of Canada, and by the Ontario Provincial Police for precisely that purpose. They do intelligence operations. The call center, by the way, and the intelligence operation is run out of North Bay. It's got a concentration of offices there who concentrate on all these fraudulent issues. So I'm just wondering if you have done something in that area, because talking to police forces is not going to help you. I think you've recognized that, but talking to the Anti-Fraud Center would. Because what they do is they gather up the number of cases, the $10,000 case that becomes hundreds of millions of dollars by a fraud artist. And then they can have the basis for tackling that particular kind of fraud. The other thing, so that was my first question, that at least I'd hope you consider that, and I'd like to comment on that. The other thing is, in the Interact case we've just been talking about, there is the issue of the, I think it was her email that was hacked. What is the partnership between people in the payment space and internet service providers that might have helped identify the hack in the first place and a more timely identification of the hack? Because the whole payments ecosystem has made this kind of system where you have these kinds of emails or telephone numbers as the sort of payment mechanism rather than an account number, has made it part of the system. And consumers think, I can use my email, I can use my phone number. So it seems to me you need to do more partnering with people who are, you've brought into the ecosystem without perhaps thinking they're in the ecosystem. Thank you.
I would just say that that's where the information sharing comes in, and that's where right now it is difficult to information share. And as we add more players like that that are non-financial as part of the payment process, you just basically make that problem become more acute, because you both have the issue of sharing within the financial system as well, but as well with these third parties that are really tied into the authentication really at the end of the day. So I think it needs to kind of include both a stepping back on information sharing as well as the identity portion in terms of trying to address that properly.
So we've hit our time. So thank you very much for the many questions, which I think was really helpful to get us going and engage in the discussion. We'll hang around if there are other questions. Just want to thank you all for your attention and engagement in the discussion, and thank our panelists for coming here today, some from very far away, to contribute their thoughts to this discussion. Thank you.